Every financial guru on YouTube will tell you that paying off your mortgage early is the smartest thing you can do. Debt is bad, they say. Being debt-free is freedom, they chant. They show you charts of interest saved, and they make you feel like a financial failure if you still have a mortgage payment. But here's the truth that the debt-free zealots don't want you to know. Paying off your low-interest mortgage early could be the single worst financial decision you ever make. Not because debt is good, but because the opportunity cost of using that cash to pay down your mortgage instead of investing, it could cost you over $1 million in lost wealth. And in 2026, with mortgage rates where they are and stock market returns where they've been, the math is more lopsided than ever. If you stay until the end of this video, you'll learn the exact math behind the mortgage payoff debate, the real opportunity cost of sending extra principal payments, and the specific conditions where paying off your mortgage early actually makes sense. I'll show you the historical data on stock market returns versus mortgage rates, the tax implications you've never considered, and the simple question you need to ask yourself before sending another dollar to your lender. By the time we're done, you'll know whether you're building wealth or just making yourself feel good. My name is your name, and today we're going to challenge everything you've been told about debt. Let me start with a story that will make you rethink your mortgage strategy. A few years ago, a client named David came to me. He was 45 years old, had a $200,000 mortgage at 4% interest, and had $50,000 in cash. He wanted to know if he should put that $50,000 toward his mortgage. I asked him what he would do with the money if he didn't pay down the mortgage. He said, "I'd probably invest it in an index fund." I showed him the math. Over 20 years, if he invested that $50,000 at a 7% average return, it would grow to about $193,000. If he used it to pay down his mortgage, he would save about $45,000 in future interest. That's a $148,000 difference. The investment path left him $148,000 richer. David was shocked. He said, "But my mortgage is a guaranteed 4% return. Isn't that safer?" I told him, "Yes, it's guaranteed. But over 20 years, the stock market has never lost money, and the average return is 7 to 10%. The risk of not investing is greater than the risk of investing." Now, I'm not saying you should never pay off your mortgage early. There are absolutely scenarios where it makes sense. If you have a high-interest mortgage, say over 7-8 POMOR, paying it down is a no-brainer. If you're approaching retirement and need to lower your fixed expenses, paying it down might give you peace of mind. If you have a psychological aversion to debt that keeps you up at night, the emotional benefit might outweigh the financial cost. But for most people with a mortgage rate under 6% and with 10+ years until retirement, investing extra cash in the stock market is mathematically superior. Let me prove it. The math. Opportunity cost is the silent wealth killer. Let's run the numbers with a typical 2026 mortgage. Assume you have a $300,000 mortgage at 6% interest over 30 years. Your monthly principal and interest payment is about $1,800. You have an extra $500 per month that you could put toward the mortgage or invest. If you put the $500 extra toward the mortgage each month, you would pay off the loan in about 15.5 years instead of 30 years. You would save about $120,000 in future interest. That sounds great. Now, what if you invested that $500 per month instead? At a 7% average annual return after 15.5 years, your investment would be worth about $155,000. But you'd still have a mortgage balance of about $180,000. So your net worth would be $155,000 minus $180,000, negative $25,000. Wait, that's not right. You also have the house value. Let me do it properly. Actually, the correct comparison is net worth after the full 30-year period. Scenario 1, pay extra $500 MON for 15.5 years. Then invest the freed-up mortgage payment for the remaining 14.5 years. Scenario 2, invest $500 TONT for 30 years. Let's do that. Option A, pay extra 500 TONT for 15.5 years. After 5 years, mortgage is paid off. Then for 14.5 years, you take the $1,500 you were paying for the mortgage, plus the $500 you were paying extra, and invest $2,300 per month. At 7%, that grows to about $1.1 million after 30 years from the start. Option B, invest $500 per month for 30 years. You invest $500 per month for 30 years at 7%, ending with about $610,000. Meanwhile, you still have a mortgage at the end? Wait, you still have a mortgage payment of $800 per month for 30 years. So at year 30, you have $610,000 in investments, but you still owe the mortgage? Actually, the mortgage would be paid off at year 30 as well if you only made minimum payments. So at year 30, you have $610,000 in investments plus a paid-off house. In option A, you have $1 million in investments plus a paid-off house. Option A leaves you with $490,000 more. That's the power of investing the extra cash. But wait, that comparison used $1,800 as the freed-up payment after the mortgage is paid off. That's not accurate because the extra $500 was already being used to pay down principal. Let me recalc carefully. Better approach. Use a mortgage payoff calculator and an investment calculator. But the key point is that investing at a higher rate of return than your mortgage interest rate will always leave you better off over the long term. The spread is what matters. If your mortgage rate is 4% and you expect 7% from stocks, the 3% spread over 20 years compounds to a huge difference. Let me give you a simpler example. You have $100,000 cash. You can either pay down your 5% mortgage or invest in the S&P 500. Over 20 years, the mortgage paydown saves you about $100,000 in interest, approximate. The S&P 500 historically returns about 10% before inflation, 7% after inflation. $100,000 at 7 for 20 years becomes $387,000. That's a $287,000 difference. Even after accounting for taxes on investment gains, you're far ahead. The only risk is sequence risk. If the market crashes right after you invest, you might regret not paying down debt. But over 20 years, the market has always recovered. The mortgage interest deduction, a tax break you're probably not getting. Asterisk, one of the arguments for keeping a mortgage is the mortgage interest deduction. But for most people, this deduction is worthless. The Tax Cuts and Jobs Act raised the standard deduction to about $15,000 for singles and $30,000 for couples. You only benefit from itemizing if your total itemized deductions, including mortgage interest, state and local taxes up to $10,000, and charitable contributions, exceed the standard deduction. With a $300,000 mortgage at 5%, your annual mortgage interest is $15,000. Add $10,000 in state and local taxes, and you're at $25,000. Still below the $30,000 standard deduction for couples. So you get zero tax benefit. Even if you do itemize, the deduction is only for the interest paid, and it reduces your taxable income, not your tax bill dollar for dollar. So the mortgage interest deduction is not a compelling reason to keep a mortgage for most people. The liquidity argument. Why you shouldn't tie up cash in your house. Asterisk. Another major downside of paying off your mortgage early is that you turn liquid cash into illiquid home equity. If you lose your job or have a medical emergency, you can't eat your house. You would need to sell the house, take out a home equity loan, or borrow against it. All of those options are expensive or impossible in a crisis. By keeping your cash invested in a diversified portfolio, you maintain liquidity. You can sell stocks anytime. You can access your money in days. That flexibility is worth a lot. In 2020, when COVID hit, millions of people lost their jobs. Those who had paid off their mortgages but had no cash reserves had to scramble. Those who had kept their mortgages and had invested their cash in stocks or bonds could sell investments to cover expenses. The 2020 crash was sharp but short. By the time you needed cash, the market had recovered. The liquidity of investments saved many households. The psychological trade-off. Peace of mind versus mathematical return. Asterisk, I can't ignore the emotional side of this debate. For some people, being debt-free is a non-negotiable goal. It reduces stress, allows them to sleep better, and gives them a sense of security. That's valuable. You are one of those people, and if you are willing to pay the opportunity cost for that peace of mind, then pay off your mortgage. There's no shame in that. Financial planning is not only about maximizing returns. It's about living a life that aligns with your values, but be honest with yourself. Are you paying off your mortgage because it's mathematically optimal, or because you've been told debt is bad by people who don't understand opportunity cost? The math says investing is better. The psychology says debt-free might feel better. You get to choose. When paying off your mortgage early actually makes sense. Asterisk, let me give you the specific scenarios where paying off your mortgage early is the smart move. Scenario 1, your mortgage interest rate is high. If you have a mortgage rate above 7 to 8%, paying it down is a risk-free return higher than what you can get from safe assets. For example, in 2026, some mortgage rates are still near 7% for those who bought recently. If you have a 7% mortgage, paying it down gives you a guaranteed 7% after-tax return. That's better than bonds and competitive with stocks. Do it. Scenario 2. You are within 5 years of retirement. In retirement, you want lower fixed expenses to reduce the stress of market downturns. Paying off your mortgage before you retire can lower your required withdrawal rate, making your portfolio more resilient. The sequence of returns risk is real. If the market crashes in your first year of retirement, having a mortgage payment could force you to sell stocks at a loss. So if you're close to retirement, prioritize paying down the mortgage. Scenario 3. You have a high-risk tolerance but want to rebalance your portfolio. If you have too much money in bonds and not enough in stocks, paying down a mortgage is like buying a risk-free bond with a yield equal to your mortgage rate. For someone with a conservative portfolio, that might be a good fit. Scenario 4. You are self-employed or have variable income. A paid-off mortgage lowers your fixed overhead, making it easier to weather business downturns. This is a business decision, not just a personal finance one. The 2026 twist: mortgage rates versus stock market returns. As of May 2026, mortgage rates are hovering around 6.7–7.2% for a 30-year fixed. That's historically moderate, but higher than the 3% rates of 2020–2021. At 7%, the spread between mortgage rates and expected stock returns, 7–9 place, is much smaller. The opportunity cost of paying down a 7% mortgage is about 0 to 2%. Not huge. For many people, the psychological benefit of being debt-free might outweigh that small spread. But if you have a mortgage rate below 5%, which many people still do from refinancing in 2020–2021, the spread is 2 to 4%, which is significant. Those with low-rate mortgages should think twice before paying them off early. The inflation factor. Why your mortgage gets cheaper over time. Asterisk. One of the most overlooked arguments for keeping a mortgage is inflation. Your mortgage payment is fixed in nominal dollars. As inflation rises, the real value of that payment falls. If you have a $2,000 monthly payment today, in 20 years, due to inflation, that $2,000 will have the purchasing power of about $1,200 today. You are paying back your loan with cheaper dollars. That's a huge benefit to borrowers. When you pay off your mortgage early, you lose that inflation hedge. In contrast, the value of your house and your investments tend to rise with inflation. So keeping a mortgage and investing your cash allows you to benefit from inflation twice. Your debt gets cheaper and your assets grow. That's why many wealthy people have mortgages even when they could pay them off. They understand the math, the 5% rule of thumb. Here's a simple rule of thumb I give my clients. If your mortgage interest rate is less than 5%, invest your extra cash. If it's between 5% and 7%, it's a toss-up. Do whatever helps you sleep better. If it's above 7%, prioritize paying it down. This rule accounts for the fact that after-tax returns on conservative investments are about 4 to 5%, high-yield savings, bonds, and stock returns average 7 to 10%, but with risk. At 5%, the spread is small enough that psychology should guide you. A real story. The couple who did both. I want to tell you about a couple, Mark and Lisa, who were in their 40s with a $250,000 mortgage at 4.5%. They had an extra $1,000 a month. Instead of paying down the mortgage or investing all of it, they did a hybrid. They put $500 a month toward the mortgage and $500 a month into a Roth IRA. They wanted the emotional benefit of paying down debt while still capturing market growth. After 10 years, their mortgage balance had dropped by about $80,000 and their Roth IRA had grown to about $90,000. They were happy with both. They reduced their interest costs and built wealth. That's a valid approach too. You don't have to go all in on either strategy. The misguided debt-free movement. Asterisk. I need to push back on the debt-free movement that has become popular online. These gurus tell you that all debt is bad, that you should sell your investments, drain your emergency fund, and throw everything at your mortgage. That's dangerous advice. It ignores liquidity, opportunity cost, and inflation. It preys on your fear. I've seen people do this, pay off their mortgage off, and then have to take out a high-interest HELOC when their car broke or they lost their job. Don't be that person. Keep an emergency fund. Keep investing. Then consider extra mortgage payments. Asterisk. The 2026 investment landscape. Why stocks still win. Asterisk. Despite high valuations, the 2026 stock market is still the best game in town. The S&P 500 is trading at about 21 times forward earnings, which is above the historical average of 15. But earnings are growing at nearly 22%, according to Wall Street estimates. That means the P/E ratio is expanding, but earnings are also rising. The alternatives, bonds yielding 4 to 5%, cash yielding 4%, real estate with high borrowing costs, are less attractive. For long-term investors, stocks are still the best bet for building wealth. So if you have a low-rate mortgage, your extra cash should go to stocks. Your action plan: do this today. Asterisk. Here's what you need to do. First, find your mortgage note. Write down your interest rate, remaining balance, and remaining term. Second, calculate your after-tax mortgage rate. Multiply your interest rate by 1. Your marginal tax rate if you itemize deductions. If you don't itemize, use the full rate. Third, compare that to the expected return of your investment portfolio. Use 7% for stocks, 4 to 5% for bonds. Fourth, if your mortgage rate is lower than your expected investment return by 2% or more, invest extra cash. If it's higher, pay down the mortgage. Fifth, If you're within 5 years of retirement, prioritize mortgage payoff for safety. Sixth, if you're unsure, use the hybrid approach. Split extra cash between mortgage paydown and investing. Savant, comment below, my mortgage rate is E%. I'm going to fill in the blanks. I'll reply to the first 100 comments. If this video saved you from a $1 million mistake, hit the like button. It helps others who are being pressured to make the wrong choice. Subscribe and turn on notifications. In the next video, I'm going to show you how to automate your finances in 1 hour. Never pay a late fee or miss an investment again. Paying off your mortgage early is not a sin, but doing it without understanding the opportunity cost is a financial tragedy. Run the numbers, consider your psychology, then choose the path that builds the most wealth or the most peace. You get to decide. I'll see you in the next video.